Hey, what's up, everybody? It's Tuesday, so I wanted to talk some mortgages again today. And today's topic I'm going to cover is going to be about the pre-approval, okay, and things that you can look for to determine whether or not you actually have a good pre-approval that's airtight and you know your loan is going to close once you find a house versus a bad pre-approval, okay? And the reason I'm covering this topic is because a lot of times I end up being not the first lender that you talk to. You know, I may be the second or third if you've been shopping around. And I'm finding that a lot of people have pre-approval letters that state that they're approved for much higher than what they actually qualify for. Okay, and I'm sharing this video with you today so that that doesn't happen to you. Okay, I'd like it to be so that when you go out and you're shopping for a home, you know that your loan is actually going to close because you have a good pre-approval. Okay. A couple of things that lead to bad pre-approvals are as follows. Okay, number one, just where that lender is getting your information from. Okay, if you're talking to any of these like online banks or lenders who've got 40 or 50 leads coming in a day, they can just throw some stuff at the wall and see what sticks and hope that it closes. For me, you know, that's not an option. Okay, my leads typically come in from past clients and referral partners. Okay, and if someone's going to refer their client to me and trust me with getting that loan closed and with their commission, I'm going to be doing a much more thorough job on the pre-approval process. Okay, because I have a relationship to protect. If I mess up, that referral partner is never going to send me business again. Okay, so the way you avoid those mess ups are as follows. Okay, number one, go ahead and write this down. Number one is to make sure that your lender is doing a credit check. Okay. And not just looking at the scores, you know, actually doing a thorough credit review with you and asking you questions about any student loans that may show up, any, you know, past derogatory accounts like judgments or collection accounts. If they're not asking you about those things, that should be a red flag, okay? Because all of that stuff matters, okay? Like if you've got student loans, you know, if you've got a lower credit score and you need to go FHA, you're going to have to account for 1% of that balance as your payment. Whereas on conventional, if you have better scores, you know, that may not be an issue. Okay, so number one, just make sure they're doing a thorough review of the credit. Number two, you want to make sure that they're actually reviewing your income documents. Okay, so if you've got a pre-approval letter and you've never sent a pay stub to the lender, or you never sent them your tax returns or W-2s, that's a problem. Okay, because there's a lot of things on those pay stubs and W-2s and tax returns that could come up and affect your loan, okay, and how much you would have qualified for. All right, so that's number two, verifying your income documents. Number three is going to be verifying your bank statements for your down payment, okay? And this is a topic I covered last week, so if you want to go back and watch that video, there's a lot of good insight into that. But basically, it's just making sure that the funds you say you're going to be bringing to the closing are actually verifiable and in your account, okay? So I think that's it. You know, those are the three, main things you can do as a buyer to make sure that you have an airtight pre-approval, okay? And as an agent, to ask your buyers if they've done those things, okay? And if they haven't, maybe you should rethink that pre-approval letter that they have and have them inquire with another lender. Okay, so that's all. I hope it helps, and we'll see you next week.